Welcome to Thoughts on the Market. I'm Jonathan Garner, Chief Asia and Emerging Market Equity Strategist for Morgan Stanley Research. Along with my colleagues bringing you a variety of perspectives, I'll be talking about Asia and emerging market equities in the year ahead. It's Monday, February the 14th at 8:30 p.m. in Hong Kong. Welcome to the Year of the Tiger from the Morgan Stanley team in Asia. Ferocious, brave, and intelligent, the tiger inspires us to navigate the multitude of risks which confront investors today. For us in Asia, we're at first sight on the sidelines of the action as expectations build for a sea change this year in monetary policy in the US and Europe. Indeed, we have a degree of sympathy with the argument that the different phase of the monetary and fiscal cycle in China, in essence a moderate easing, is a key reason to be more constructive on Asian markets' performance this year in both absolute and relative terms. However, divergent policy cycles are only part of the story. North Asia has already benefited substantially from the major shift towards goods spending and away from services, which has been such a unique feature of the COVID-driven recession and recovery. Now, as that starts to reverse, given the reopening trend in the US and Europe, we may see earnings growth in markets like Korea and Taiwan slow. Moreover, significant challenges in relation to COVID management still beset the region, most notably in Hong Kong, which is experiencing its largest surge in cases since the pandemic began. A key call that Morgan Stanley's equity strategy team made 3 months ago in our year-ahead outlook was that investors on a worldwide basis should rotate away from growth stocks, that is, stocks with high expected earnings growth and high valuations, towards value stocks, that is, those with lower valuations, more dividend yield support, and lower anticipated earnings growth, not least due to the fact that many businesses in the value style category tend to be more established than growth stocks. This rotation has indeed taken place, as evidenced not just by Nasdaq's underperformance in the US, but also the underperformance of growth stocks in Asia and emerging markets. This has been reflected in indices like Kosdaq in Korea or the TSE Mothers Index in Japan. In fact, in Japan, banks and insurers, stocks which investors have not focused on for a long time, are leading in performance in 2022, whilst in China, bank stocks have been outperforming internet stocks for some time now. For those of us who worked through the 1999 to 2002 cycle in global equities, things seem very familiar. History rhymes rather than repeats, but the catalyst for growth stock underperformance then, as now, was a sudden repricing of interest rate hike expectations with a shift higher in nominal and real interest rates. That higher hurdle rate depresses valuations for equities generally, but particularly for higher multiple growth stocks, further motivation for the rotation towards value stocks. So investors may need to start thinking like the tiger in order to leap over that hurdle and land safely on the other side. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.